So what are some of the tax benefits that someone can receive when they're giving a gift to charity at their death?
Yeah, so most people, when they think about giving a gift to charity upon their death, think about their will.
Mm-hmm.
And including charity, naming a charity as a beneficiary of their will.
That's the most common way of giving it.
It is. And I just helped a family here last week, and we set up their estate plan. They included charity in their will. And he happened to call me, and he said, hey, I'm sitting here with my accountant, and she wants to know if I'm going to benefit on my taxes by what I did. And so I had to explain that, no, you will not receive any tax benefits currently because you haven't completed a gift.
Right. Yeah.
And so he understood that. Mm-hmm. But there are cases where you can receive a tax benefit now.
Well, what are some of those cases then?
Yeah, so the thing to remember is that you have to give up ownership. For the IRS to say, hey, yeah, you're going to get a benefit, a tax benefit, you have to give up ownership of that asset. Mm-hmm. And so here's a couple ways you can do that. One is through the charitable gift annuity. So what you do is you transfer cash or other assets to a charity, and you don't own that asset anymore. Mm-hmm. You're going to get an income from that, but you give up the ownership.
Okay.
The charity's not going to benefit from that gift until you pass away. However, the IRS says because you've given up that ownership, we're going to let you have the deduction now.
Okay, and then you get the stream of payments, right, from a charitable gift annuity?
You do, and so it's kind of a win-win.
Yeah.
Because you get that deduction, you get that stream of income, and eventually the charity will be able to use that gift.
So you get to use it some way, but not completely. You've relinquished control, but you're still receiving some benefits.
Exactly.
Okay. Yeah.
Another way that people overlook is through life insurance.
Okay.
So you can do it one of two ways. One, you could buy a life insurance policy. The owner has to be the charity, and the beneficiary has to be the charity.
Okay.
But you can pay the premiums, and you'll get a tax deduction for those premiums.
Okay. Now, are you the one that's being covered on the policy then?
So the person, the donor who sets up that life insurance is on their life.
Okay.
Yeah. But what that does, though, it's a way for them to make a gift eventually upon their death to the charity, but they can get those tax benefits now because they pay the premiums, and they can deduct those premiums as a deduction.
Well, there'll be a much bigger payout at the end, too, with the death benefit.
It's a way really to leverage your charitable gift so that eventually the charity is going to benefit more.
Okay.
So, but both of those are great ways to make a gift now, receive that tax benefit, but the charity will benefit in the future.
Well, thank you for helping us understand a couple of ways that someone could make a gift later but get some tax benefits today.
You're welcome.